All right, let's dive right into this. Welcome to our Financial Explainer, where we're going to put Heritage Financial through the absolute ultimate interrogation. We're bringing in the heavy hitters today, using the exact analytical frameworks of legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside a modern discounted cash flow valuation. By the end of this, we're going to know exactly what this company is really worth. Here is our game plan to find the true fair value of this stock. First, a company snapshot. Second, the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, DCF and other models. And finally, number 6, our synthesis and final recommendation. Let's get to it. Starting off with Section 1, Company Snapshot. Meet our subject today, Heritage Financial, trading under the ticker HFWA. Right now, it's sitting at exactly $30.52 a share. At this price point, the market is giving them a total capitalization of roughly $1.3 billion. What are we actually looking at here? Well, they're a solidly entrenched commercial bank operating 65 branches across the Pacific Northwest. We're talking Washington, Oregon, and Idaho. They manage a pretty massive $8.49 billion in total assets. Looking at the current valuation, the market is assigning them a moderate price-to-earnings ratio of 15.3 and a price-to-book of 1.2. Plus, they're paying out a very solid 3.1% trailing dividend yield. Not a bad baseline at all. Let's move to Section 2. The Warren Buffett lens. Our first legendary detective stepping into the room is the Oracle of Omaha himself, Warren Buffett. Let's run his qualitative checklist. Economic moat? They've definitely got strong regional banking relationships. Return on equity is holding nicely stable at 13.1%. Debt is highly manageable too. They boast a robust total capital ratio of 13.5%, which easily clears regulatory hurdles. And management passes the honesty test with verified insider trading policies. But their earnings consistency is a bit mixed. We're looking at $67.5 million in net income for 2025, which is a pretty big jump from $43.3 million in 2024. That kind of volatility is something Buffett would absolutely scrutinize. Next up, Buffett always wants to calculate what he calls owner earnings. Now, since we don't have exact capital expenditure data in our proxy sources, we have to make a standard analyst assumption here, that depreciation roughly offsets CapEx, which is pretty typical for a mature regional bank. Using their Q1 26 net income of $18.9 million as a run rate, we can estimate their annual owner earnings sit right around $72 to $75 million. So, the million-dollar question, would Warren Buffett actually buy in at $30.52? Probably not right now. Buffett demands a massive margin of safety. While the balance sheet looks sturdy, their non-accrual loans have been ticking up lately. He'd almost certainly hold out for a much lower entry price just to make absolutely sure his downside is fully protected. Moving right along to Section 3, the Peter Lynch lens. Peter Lynch loves to categorize his stocks. Looking at Heritage Financial's modest 4.3% dividend growth rate and their highly established regional footprint, Lynch would absolutely classify this bank as a classic stalwart. They aren't a rapid, explosive grower, but they're exactly the kind of company that provides a sturdy, defensive foundation for a portfolio. And here is where Lynch's eyes would really light up, the PEG ratio. If we assume forward earnings estimates yield roughly 15% growth, dividing our current 15.3 PE by that growth rate gives us a PEG ratio of 0.96. For Lynch, anything under a 1 is basically the holy grail. It perfectly signals growth at a very reasonable price. But wait, there is a huge catch here. Check out this towering institutional ownership, 78.3%. Lynch actually views this as a massive red flag. Why? Well, because if the smart money is already this heavily crowded into the stock, the hidden upside has probably already been discovered and baked right into the price. Let's move on to Section 4, the Benjamin Graham lens. Time to bring in the father of value investing himself, Benjamin Graham, to run his notoriously strict, purely quantitative gauntlet. Let's look at his defensive investor checklist. Adequate size? Pass, with a $1.3 billion market cap. Strong financial condition? Pass, thanks to that 13.5% capital ratio. Earnings stability and a steady dividend record? Pass on both. Price to book under 1.5? Pass, it's sitting nicely at 1.2. Honestly, the only place it barely stumbles is the PE ratio. At 15.3, it just squeaks past his absolute hard limit of 15.
Now let's actually do the math on Graham's legendary intrinsic value formula. We take the square root of his constant, 22.5, multiply it by the 2025 earnings per share of $1.96, and multiply that by the book value per share of $27.05. Plug all that in, and boom, it spits out an intrinsic value target of exactly $34.53.
So, with the stock currently trading at $30.52, Graham's formula gives us an 11.6% margin of safety. That's definitely intriguing. It tells us the stock is mathematically undervalued today. But just to be realistic, it might not be quite deep enough for Graham himself, since he usually demanded a massive 25 to 30% discount before taking the plunge. Section 5. DCF and other models. Let's step away from the historical gurus for a second and project the future using modern corporate finance techniques, specifically a discounted cash flow analysis. For our base case DCF, we're forecasting out 5 years. We'll use their net income of about $72.6 million as our free cash flow proxy. If we input an industry average 10% discount rate, or WACC, and a highly conservative 2% terminal growth rate, our model yields a fair value right around $30.60 per share. But you know how it goes. DCF is quite literally only as good as its inputs. This sensitivity table lays it out perfectly. Look at what happens if rising interest rates push that cost of capital up to 12%. The fair value drops off a cliff down into the mid-20s. So our assumptions really matter here. To cross-reference that, let's look at the dividend discount model. Just look at this incredibly consistent history of payout growth. They've been stair-stepping up from 84 cents back in 2022 to an estimated 96 cents in 2025. This steady, income-driven baseline gives tremendous downside support to the stock's overall valuation. Finally, Section 6, Synthesis and Final Recommendation. All the evidence is gathered, the numbers are officially crunched. When we map the fair values generated by every single approach we just used, we see something pretty remarkable, an incredibly tight consensus. Analyst targets say $31.40. The Simply Wall Street narrative says $30.60. Our own base case DCF landed at exactly $30.60. Even Graham's super strict formula suggests $34. Literally everything is clustering right at or just slightly above the current trading price. So, let's weigh it all out. The core strengths here are undeniable. Rock-solid capital ratios, a highly consistent dividend, and great tangible book value. But we have to balance that against the real risks. Namely, the rising risk in their commercial real estate loan portfolio, where non-performing assets ticked up a bit, plus that heavy institutional crowding might put a ceiling on any explosive upside. Which brings us to our final verdict. For right now, it is a hold. The stock is absolutely fairly valued today, making it a solid, reliable, income-producing hold. But the real question for you as a disciplined investor is this. Do you have the patience to wait for a broader market dip, say down to the $25 range, to unlock that massive, true margin of safety that these legendary gurus demand? Let that simmer for a bit.